The government tells all of us that retirement happens at 65. Well, now it's 67. But I'm here to tell you that, sure, that is the default setting for people who never really take the wheel on their finances or their retirement. I retired at 46, and it started really slow. I had to understand the basics by building myself a foundation. And I tried to make all those small mistakes early on so I could learn faster and invest smarter over time. And that knowledge quickly grew. Over the last 5 years, my portfolio has grown over 300%, while the S&P 500 grew roughly 95%. So today, I'm going to give you a look under the hood. I'm going to walk you through my entire portfolio, and I'm going to show you how I use different account types, how I find and select my stocks, and the system that I built to track over 70 holdings without it becoming a full-time job. Now look, this isn't about providing just a stock list. This is the whole machine about how I manage my accounts, why my portfolio looks the way that it does, and how I research growth and quality stocks over time. And throughout this video, you're going to see my process working in real time. I have automations that are running right now that are monitoring my portfolio. They're filtering out all the news that's happening, and it's really keeping me informed about all of this at once. And of course, I want to show you those things as they pop up because that's the system doing its job. And before jumping in, I do want to thank today's sponsor, Hostinger, but of course, I will get to that later on. Now, to understand my portfolio, you can't just simply look at the tickers. You have to understand the structure and the reason behind them. I split my wealth into 2 different zones, which I highly recommend that everyone consider having. Zone 1 is my cash accounts. These are accounts that I fund with money that I've already paid my taxes on. They make up roughly about 25% of my managed portfolio's value. And Zone 2, well, that's my tax-advantaged accounts. This is going to be my IRAs, Roth IRAs, 401ks, and even my HSA. These accounts are where money grows tax-deferred or tax-free depending on the account type. And this is where 75% of my managed portfolio is living. Now, before I go any deeper, I do need to call out the elephant that is in the room because I had worked at Amazon and I still hold a ton of RSUs or restricted stock units because Amazon stock alone makes up over 20% of my total wealth. But I don't count it as part of my managed portfolio because I'm not actively doing anything with it. I'm simply letting it grow until I absolutely need to sell. And of course, when I do sell those RSUs, they fall into the same bucket as my cash accounts because I'm going to owe taxes on every dollar of profit. So for now, they just simply sit and grow. Everything that I'm going to walk you through today is the portfolio that I actively manage and I make decisions on every day. Now let me break down why each zone works the way that it does. Now for Zone 1, these accounts hold almost half of my tickers, even though they're only about 25% of my managed value. This is also where the bulk of my ETFs and my large cap holdings live, and there's a very good reason for that. You see, when I first started learning how to invest, ETFs and established large cap companies were the safest, most straightforward way to get into the market. I knew that these were evergreen and they were going to continue to grow over time without a lot of risk of failure. In my mind, they were going to be around for the long haul. And because this is a cash account, I wasn't going to make speculative bets where I might need to sell and trigger a tax event. Essentially, I wanted to learn with positions that I could buy and hold with a lot of confidence. And that's why some of these are such small positions, and some are just legacy holds. And I don't want to sell them because in a cash account, the moment that you sell, I'm suddenly going to be handing over 20 to 30% of my gains to the government in capital gains taxes. So instead of cleaning house just to make things look pretty, I just let the money keep compounding. Now, that doesn't mean that I'm going to hold them forever no matter what. If the fundamental thesis breaks, or the company changes direction, leadership falls apart, or it's no longer the same business that I bought into, of course, that's when I'm going to exit. But on the flip side, I'm not selling a winner just because my portfolio looks a little messy or to capture margins. I also do not have any big dividend stocks or ETFs in my cash account. If I did, taxes would take a hit every single year on the dividends, and it would reduce my growth. So I just don't do it. But this Zone 1 account does answer the question that I get most often of why do I have some holdings that are such a small percentage? And it's simple. It's because I bought them when I was learning, and I have no reason to sell them. And it also helps answer why I have so many holdings. Well, at least sort of. But Zone 2 gives a lot more meat behind that particular question. Now on to Zone 2, and this is where the real machine lives. It's my tax-advantaged accounts, which include my Roth IRAs, traditional IRAs, and of course, my HSA. As for me, I rolled my retirement money out of traditional 401ks and into a self-directed account so that I could control what I invest in, instead of me simply being stuck with a handful of generic mutual funds that someone else picked for me. And because I'm able to pick whatever I want, this is where the heavy hitters really live within my portfolio, and it's where the real explosive growth has been happening. And here's the advantage that most people miss. Inside these tax-advantaged accounts, I can buy, I can sell, and I can rebalance without triggering a single taxable event. That means if something runs too hot, well, I can just trim it. And if I want to rotate into a better opportunity, once again, I can just move it without taking any of those taxes. Essentially, the seatbelt sign is off and I am free to roam about. And this is where the asymmetry of my investing really takes hold. The bulk of this zone is core growth stocks and a few ETFs and a couple dividends. Those happen to be my foundation. But then, of course, I take a very small, calculated position in speculative, high technology names. And because this is a tax-advantaged account, when one of those doubles or triples in size, I can trim it, I can lock in my gains, and I can protect my initial investment, all without taking a single tax consequence. And of course, I cannot do that in Zone 1 without paying the government first. And this is why I have several small percentage holdings, because many are unproven with no real strong fundamentals, because they're still in their startup mode. That's why this zone is the horsepower behind everything that I'm doing within my investments. And having these two zones of accounts, it may seem really simple and obvious, but a lot of you aren't doing it. And if you follow that strategy, it will save you thousands upon thousands of dollars over the lifetime of investing. Okay, now that you understand the structure, let me show you what's actually inside. I break my holdings into two categories. I have my rock stars, and of course I have my seeds. And as a quick reminder, I do share my portfolio in my free newsletter, so I'm not holding you hostage with my information. I try to be as transparent as I can so that you can observe and make your own decisions. These rock stars are the names that carry the entire portfolio. These are companies that I have extreme high conviction in, and they make up the bulk of my weight. Semiconductors are my primary engine. NVIDIA, Broadcom, AMD. These companies are the foundation of the entire AI revolution. Every data center, every AI model, every cloud platform is built on top of their chips. Without them, none of it is going to run. Then, of course, on the software platform side, you've got Microsoft, Apple, Alphabet, Meta, Amazon. These are the backbones of modern infrastructure. Because when you own these, you're not betting on just one product. You're betting on the platforms that the entire economy is currently running on. And of course, you're going to find these rock stars in both of my zones 1 and 2. They show up in my cash accounts as older, established positions that I've held for years. And they show up in my tax-advantaged accounts where I actively add to them and I manage my sizing. Then we move over to my smaller positions, which I refer to as the seeds. These happen to be my asymmetrical bets because they're early stage technology, like nuclear energy and uranium. Well, those are bad examples because that's existing technology, but because of AI, it has a higher demand now, just like quantum computing is way ahead of its time. So these are all my high upside growth drivers. Now, of course, here's the deal with seeds. If they go to zero, my rock stars still protect my portfolio. So there's really no reason for me to lose any sleep over them. But if they hit, so if one of these doubles, triples, or goes to 5 or 10x, that's what generates the alpha that really beats the S&P 500. And because most of my seeds live in zone 2, I can trim the winners and I can protect my initial investment without any tax consequences. Oh, and see right there, I was just talking about this with my system that just flagged me about stocks and a potential entry or exit, and I did plan my filming around this so that I could show it to you. I didn't have to go looking for that information. That came to me. And that's what this personal machine does. And this is how anyone can leverage AI for themselves. So not only do I talk about AI as investments, but I'm in it every day to understand it and to free up as much time as possible by leveraging it with things like this. Sorry, I really enjoy geeking out over those things. So now that I've covered my strategy for my two types of accounts and my holdings that I have in each of them, let's go ahead and jump into the process on how I research. Because in my opinion, the real question isn't just about what I own, it's how I find these companies in the first place. And I have to say that I don't rely on any single source. I pull from multiple angles to build my entire watch list. I am constantly taking in information. I watch other YouTubers that are within this space, and I also read a lot of news articles and earnings reports that I think a lot of people try to do. In addition, I use investing websites that allow me to screen and filter out companies by sector, market cap, and growth metrics, which I'm going to show you. And of course, one of my favorite methods is the ETF deconstruction. I look at thematic funds like semiconductor ETFs, AI funds, clean energy funds, whatever it is, and I pull all of their holdings, not just the top 10 or the top 20, but all of them, because buried in those funds are names that most people never really look at, and those can oftentimes be where some of the best opportunities are hiding. As a quick example, let's look at SMH, which is an ETF on semiconductors, where I can see all the big names in the top 10 holdings like Nvidia, Broadcom, and Micron. But you may not be familiar with KLA, which makes process controls for creating semiconductors. And if we go down another page, we may see other stocks that we aren't even familiar with, like Analog Devices or Cadence Designs. And that's why ETF deconstruction can be so powerful. Now, another method that I often take is to go into a financial website of my choosing, so go ahead and try this on your own, where they have stock screeners. I'll go ahead and I'll select analyst consensus of buy, and sector, I'm going to pick utilities, tech, and energy. From there, I'll pick a low PE or price to earnings ratio, relatively low PEG ratio, and I'm going to see what comes up. Let's go ahead and pick Toyo, which I am completely unfamiliar with. And it looks like they manufacture industrial materials. And year to date, they are up a lot, and their PEG ratio is still relatively low. I mean, from this quick view, I can tell that maybe this is a stock that I should dig into further. And of course, there you have it. That is pretty much how I begin my journey of how I search for stocks. Now, once I have sourced all these different names from across all these different channels, then I feed them into my own self-brewed system, which is what generated my auto email that I had showed you a little bit earlier. And of course, that is where the work really begins, because managing over 70 holdings by hand is already challenging. But then again, my watch list is well over 200 stocks. And if you try to track all of that manually, you're just going to burn out. You'll make emotional decisions and you'll start trading reactively instead of strategically. So I did build my own system a long time ago. And of course, I keep adding to it because there's a new feature that I always want. And it is a spreadsheet dashboard that really pulls in real-time data across my holdings and of course my entire watch list. It tracks all the fundamentals, it tracks the technical signals, it tracks the balance sheet health, and it tells me when something is gaining in strength and when something is starting to break down, whether that's a stock that I already own or one that I've been waiting for the right entry point. I'm the first to tell you that I do not sit there watching the market all day. Instead, I just check my dashboard, or better yet, I let my dashboard email me because of course I do have it set up on an automation where I get at least 2 emails a day. The first one being just a few minutes after the market opens, and of course, one later in the afternoon. But if there is unusual activity, once again, it sends me an alert. And here's another important component to my investing system. And this is where the layer that ties this all together. I built a very simple system that pulls news across my entire watch list and my holdings, which once again is over 200 stocks. Every day, it's scanning for earnings, Fed moves, CEO changes, analyst upgrades, contract wins, really anything that would move the needle. And then it's really smart and it extracts only the things that are most important to me so that I can gauge whether or not I need to take action. And I will share these automations down in the description if that interests you. And also know that I'm trying to share more of this broadly on my Patreon and Discord, and it's free to sign up if you want to because I'm in beta, just so you know. But I want to point out that for me, I'm not scrolling through hundreds of headlines trying to figure out what really matters. The system does that for me, and it puts what I need to know right in front of me. Now, is it perfect? No, far from it. It's not even close. But for the time that it saves me, it's perfect enough for my needs. And like I said, I'm going to share those N8N automations for RSS feeds down below, but it is specific to my Google Sheets, so it isn't exactly cut and dry. But I will point out that the N8N automation site has hundreds of free automations similar to this, and it may be a better option. So I'll leave a link down below for those of you that may be interested. Because I have to point out that if you're looking to gain a new skill set, learning automations like this could really pay off. And automations like this isn't just specific to my investing. These run across my entire life. My reality is that I get hundreds of emails a week where viewers are reaching out, there's business inquiries, there's newsletters, and there's also just a lot of noise. I built a triage system that automatically sorts my inbox. Now, it doesn't answer my emails, it just lets me know which ones are important. And this happens to be the part of AI that everyone can be learning today. So I'm honestly a very big fan. Because here's the thing, I'm retired. And being retired isn't about sitting on a beach doing nothing. Well, at least it's not for me. It's about having the freedom to use my time the way that I choose. And for me, time is the most precious asset that I can possibly have. And I refuse to waste it sifting through an inbox or staring at stock tickers when a system honestly can do that all for me. And that brings me to the engine that runs all of this. So far, you've seen the dashboard updating itself, and you've seen email alerts come over from it. You've seen the email triage, which I've stated is all automations, which is why today's video is sponsored by Hostinger, who I actually reached out to because I absolutely love this technology. Where I'll quickly give a high-level view, and as a heads up, people are making serious bank creating these types of automations. In fact, I talked about it in a video like 2 years ago, and I know some people actually took action on it, and I hope they're doing really well. I happen to run my automations on what's called a VPS, or a virtual private server. Think of it as a computer that you rent in the cloud that never ever shuts off. So instead of everything running on your laptop and dying the moment that you close it, your workflows are running on a dedicated server around the clock 24/7. And the tool that I use to build those workflows is called N8N. Think of N8N like a digital assembly line. It connects your apps, it pulls data, it moves information between systems, and it triggers actions automatically. This is what powers my news filter, and it updates my spreadsheets, it sorts my emails, it sends me alerts, all without me really having to lift a finger. So if you go to Hostinger, they have a self-hosted N8N setup ready to go. And this is what I recommend if you want to build your own automation system. And there's a lot of reasons for doing it. Like I said, saving time. Or maybe you just want to make money from it. For this type of project, the plan I'd recommend is the KVM2 VPS plan. It's the sweet spot. It has the performance that you need without really having to overspend because, well, I'm all about saving a couple dollars. And here's the part that really matters. If you use N8N's cloud hosting, which is completely different, then you're going to have to pay monthly for that service forever, for as long as you use it. But if you self-host through Hostinger, you're using N8N essentially for free. You're just paying for the server. That can save you up to 4 times compared to cloud hosting. And you get unlimited workflows, which, hey, I'll show mine on the screen right here. Quite a lot. And it's unlimited concurrent executions and access to over 100 ready-to-use workflow templates, which is how I initially started. So you're not exactly building everything from scratch. You simply add the plan to your cart. And don't miss this. Use my link, hostinger.com/Brian, and apply the coupon code of Brian right here. That's how you get the deal. Once again, I'm all about saving a few bucks. After checkout, Hostinger walks you through the entire setup. It's straightforward, and you're not really doing anything that's overly technical. And then you install N8N using their one-click template. You click it, you install it, and hey, there you are. You are ready to go. Once it's running, this is where you deploy your workflows. This is what I use for my investing system, my email triage, and my content workflow. All of it lives right here. This is how I manage a portfolio of over 70 stocks and a watch list of over 200 and a business without really losing my mind. So if you want to build your own automation system, whether it's for investing, your business, or just getting your time back, please use my link hostinger.com/Brian. And of course, use the coupon code Brian to get that additional discount on their yearly plans. I'll put the link and the code right at the top of the description so you don't even really have to go hunting for it. All right, so now you've seen the portfolio, you've seen how I find my stocks, and you've seen the system that really keeps it all running. But none of that matters if you don't have a little bit of discipline. Because investing is never about being the smartest person in the room. It's about removing the emotion from the entire equation. Let's go ahead and talk about entries. Now, I don't chase stocks. When I identify a company through my entire process, whether it came from an ETF breakdown, a screener, or my watch list dashboard that flags me, hey, there's strength, I still don't go all in. Instead, I dollar cost average. I build positions over time. I want to see the fundamentals confirm what I'm seeing in the data before I commit to a lot of weight behind it. And there's a big difference between my two zones right here. In my cash accounts, when I enter a position, I'm making a long-term commitment. I am not buying something that I think that I'm going to need to sell in 6 months or a year or even 2 years, because selling costs alone are going to really add up when it comes to taxes. And that's where my tax advantage account comes in, where I have a lot more flexibility. I can take a starter position, I can see how it develops, and I can scale in or out without any tax consequence. Now let's go ahead and cover exits. In my tax advantaged accounts, if something runs too hot, then I simply trim it or I sell some off. If a position doubles or triples, I protect my initial investment by cashing that amount in. And then, of course, I reinvest it into the mega caps. And then I just let the rest of it ride it out. And I know that I can rebalance whenever I need to without any penalty. And that's the advantage. And of course, there's going to be people out there that are going to argue that in taking profits of my initial investment may cost me thousands if I would have just left it in and let it grow. But I'm okay with that. This happens to be my system that I use to take out all my emotion. I happen to be an investment machine and I follow my rules to a T, and it's protected me several times over the years. And on the flip side, it has lost me money at several different times. But overall, I'm still way ahead. And on the complete flip side, in my cash accounts, my sell button is basically disabled. I just don't do it unless I absolutely need to. Now, let's take a step back and be very realistic for a moment. I did not get a 300% return overnight. It started with building a very strong foundation, making small mistakes early on so that I could learn just as fast as possible, stacking my knowledge over and over until it started to compound, just like my portfolio. And that's the part that most people skip. They just want the stock picks. They want the tickers. But the tickers don't exactly matter if you don't have the structure, the process, and the discipline to manage all of them, or to manage yourself. And that's what I built. 2 zones that work together. It's a tiered system of rock stars and seeds that really balance protection with my upside. And of course, I've got a dashboard that's tracking over 200 stocks and a news filter that tells me when to pay attention. And of course, a set of automations that give me back my most valuable asset, my time, and a set of rules that keep emotion completely out of it. These are all skills that I'm trying to share via my videos, my newsletter, and Patreon, so feel free to join us in any of those different journeys. The world tells you to drop your money into a 401k, pick a target date fund, and really hope for the best. But I'm telling you that I'm proof that there is another way, but it does take work, and it takes time, and it takes a system. And of course, I realize that is not what everybody wants. Now, I do want to be clear. I do this for educational purposes, and this is not financial advice. What works for me is built on years of learning, mistakes, and a risk tolerance that may not match yours. Always do your own research, and hopefully now you have a better idea on how to do that. If you want to see me break down a specific holdings within my portfolio, the individual stocks, why I own them, and where I think they're headed, then hey, just drop a comment below and I'll try to do a full follow-up video wherever I can. And if you're not already on it, please check out my free newsletter where I share my portfolio and also some of my weekly analysis. And the link is down in the description. As always, thank you so much for watching, and please press the like button so my channel can continue to grow. And hey, we'll see you next time.